All right, Yield Nerds, happy 2025. I come to you with very exciting content, not to mention the 150th episode. Thank you for your loyal followership. This one is a big one. I bring to you, or at least I share my education of a strategy that has produced 20.22% returns in the last 90 days and counting. And I will explain what I did, and we'll see what we learn together. Hey, I'm up to 443 subscribers. I never thought there would be this many people that would care about a random yield nerd sharing his education. Thank you for your followership. We have two playlists. One is this entire show in chronological order, starting from about a middle schooler, somebody who has no idea what fixed income investing is, and up to this point. The second is one specifically about preferred stock. It's a topic that is not well covered generally, and I dive deeper, so feel free to look at that. Most importantly, and before I go any further, I am no magician. I cannot float in midair, and I may make predictions that are often wrong, and so make sure you do your own due diligence. I've organized today's content in four topics. First is the usual market temperature, as I call it. And as I play chess with bags of money with dark horses sitting behind me, I will tell you how that is panning out for me. And I will also do a Yield Superbowl. For those of you who are new to the show, I would suggest you look at some of the past episodes that are titled Yield Superbowl. We look at the pre-tax returns or yield to maturities of various fixed income investments and compare them for the same duration. So by each duration, you can make the best possible decision, or at least that's my belief, and you do you. And then I'll share some results of my momentum trading experiment, and that is where I've made 20.22% in the last 3 months, and it's going on. And lastly, I will share my holdings, and there are 4 dark horses that I'm holding, and I'm hoping these dark horses that are standing behind me are not Trojan horses, but ones that will really give me great returns. We will see. Well, before I share anything specific, I want to make sure you know that I'm not a wealth management advisor. This is not tax advice. I do not have snake oil to sell to you, and I don't do politics or product pitches. Well, my portfolio, for those of you who are new, is minuscule when it comes to equities, but I am building it out. I'm up to something north of 2.5%, somewhere around that in equities. I used to have a fraction of them before, 0.4%, and I started building it up. And I am playing with fire. I'm taking a lot of risks, and somehow it is working out, and I will share what I'm doing. Here is in the blue line, my portfolio. It is charging ahead, frankly, going meteorically higher. I am at 20.22% from October up to now. And the NASDAQ, the mighty NASDAQ, is at 9.5, so go figure. As far as my whole portfolio, my equities, as I showed you, is a very small portion of my whole portfolio, and the last 1 year returns are at 6.1%. Most of that is not state taxable. And so add another 6% to that, I'm at roughly 6.5%, which I'm very happy about. All right, let's play Yield Superbowl, my favorite game. I've been playing it for almost 3 years now. And what I mean by that is we take multiple different investments. The one that I focus on first and always to understand is the T-bill and the various treasury notes. So at the shortest end of the cycle on the treasury, this is October 2023, more than 2 years ago. And you will see that 2023 or a year and a half ago, at that time, the short-term treasuries were at a lofty 5.5%, amazing in today's standards. And how crazy is it? Even the 10-year was on a pre-tax basis close to 5%. That's just absolute insanity. That is where we were. A year later, the gray line, which is October 2024, the whole curve kind of fell down. And the Fed started saying, well, we're going to be dropping rates, and they started coming through with some rates. And the irony is the front end started dropping, but the longer end of the treasury curve, and they call that bear steepening, there are episodes about it, that is actually rising. And I look at that with great excitement. If the rear end of it goes above 5%, that to me will make me think very differently. The only thing I worry about is the potential for a default of the United States on its debt, which many would argue would never ever happen, but I would say stranger things have happened. So I do have my worries about it, but I'm hoping that doesn't come true. We'll see where it goes. Now, if you kind of move past this, and the blue line is the 125, if you kind of move past this and play the entire Yield Superbowl, meaning if you had $1,000 to invest and you wanted to spread it across the duration curve from 3 months to 10 years, how much would you put in the 3 month? What would you put in the medium term? What would you put in the long term? Would you buy treasuries? Would you buy agencies? That's really what Yield Superbowl is about. And I have a big surprise for you, a big surprise for me. The Yield Super Bowl looks nuts. There is a clear loser, a clear winner, and a pack of mediocre things in the middle. What in the world is going on? The clear loser is munis. Sorry, munis. No matter what your federal tax rate is, and I used a blended tax rate here, I do have a spreadsheet. If you want that spreadsheet, email me at yieldnerd@gmail.com. I will send you that spreadsheet. But if you plug in your federal tax rate, and start playing with it, you will see no matter what your tax rate is, munis are a dud. And so I'm not buying any munis. On the long end, corporate bonds are holding out really, really well. But you can see that the quote really, really well is still around 5.5%, 6%. So nothing to write home about. And in the middle is a whole bunch of stuff. I suppose you could buy bank CDs and say, I made 4.5%. Yay. I'm not sure I'm excited about that. So moral of the story, you can park your money in corporate long term, and there are some danger signs there, and you have to make a very smart decision there about which corporates you're willing to park it on, make whole calls and things like that. Please look at some of the playlists and look at corporate bonds to understand what those terms are and whether you should buy them, when you should buy them. The next thing you want to look at is on the short end, if you still believe there are some tumultuous things that are about to happen, and I generally keep a large portion of my allocation in the short term, you are losing yield. And so this kind of forces people like me who kind of want a yield to go look outside of fixed income. It's making the yield nerd a stock nerd or an equity nerd. And the way I think about it is as follows. I used to get 5.5% before. I am now getting 4.5%. So somewhere along the line, I need to make 1% more yield. And the 1% more yield is really on an 80% allocation because my treasuries have an 80% allocation. I still have agency bonds, which still pay very well, 5.5%, 6% in the holdings I already have, so I don't need to buy more. So the way I look at it is how do I make up 1% of extra return on 80% allocation? To say it differently, I am now in a 0.8% hole for 2025 on my entire portfolio. I need to plug 0.8% to be the same as last year. So how do I do that? And the way I'm thinking about it is I'm willing to throw 4% of my portfolio into a high risk pool, but I want to get a 20% return on that 4% that I throw in. If I do that, and if I do that successfully, I would indeed have made that 0.8% whole, and I would have done that without risking a lot. That is what I call the simple allocation strategy. I'm not going to go to 60, 40, 70, 30. I'm just not that kind of a guy. I'm still going to stay in fixed income, but I'm going to take 4% of my allocation and go high risk on the equity side to try and make 20%. And I'll tell you how I intend to do that. I covered momentum trading earlier, and let me review again. So for that 4% allocation for me, I have the following thesis. My number one thesis is that momentum, if we have seen anything at all, is hard to beat. Meaning when a stock, and we'll talk more about what momentum is and how to detect it in greater detail, but when a stock has momentum up or down, watch out, is what it says. The second is revenue growth is rewarded very, very handsomely in the growth stock business, and hence the name. So I'm going to prioritize revenue growth. But I'm still too chicken. I'm still a yield nerd. When my dollar becomes $1.50, hypothetically, I sell off the basis, which is the dollar, and play with the 50 cents. This way, I have protected my basis, and all I'm doing is playing with the gains. And slowly but surely, I convert more and more of my equity holdings into house money. And I'll tell you how I do that. And then there are some of these stocks that I truly, truly, truly believe in. Hint, hint, Calmaine eggs, that's something I believe in. I just hold it forever for long-term tax treatment and more. That is it. That is my four-step strategy for making 20% on my 4%. And so let me walk you through each step of how I'm thinking about it. Please remember to use your own judgment and your own thinking. Momentum. It's pretty simple. You go on Schwab, look at today's winners, and if you don't know where to go, the previous episode shows you how to get here. And you effectively look for the last 20%, meaning the right-hand side most 20%, and see which stocks currently trade at the right-hand side most 20%. And today is the day they took it on the chin and they've dropped by 20%, 30%. What that tells you, and you have to do more research than just looking at the screen. Please remember to not just trade based on a red color and a blue color, then you're destined to get destroyed. But you need to understand, was there an accounting scandal? Was there some new news that came through? Did anything else happen? Was there a new competitor? So you do a little bit more research. But if there is no news in the market, and it just so happens that one of these stocks that are trading at the top 20% of their 52-week range suddenly had the step back for no reason other than the entire sector is down or anything like that. Those would be what I would call a sputter after a growth streak. Similarly, if something is trading at the bottom 20% and all of a sudden they take a giant step forward, make sure that it is not an accident. Make sure that more than 60% of their open stock is being traded many times. And I don't know about these specific companies. I would get excited about a particular stock only to find out that only 1% of their float is being traded. That's useless. I can't do anything about it because the shareholders for 99% of the shares are effectively a private company. And so I make sure rather, that most of the float is trading publicly. And so if you look at the sputter after a growth streak on the right side of the curve or a glimmer after the dull streak, and you make sure that there isn't a lot of debt, and you make sure that the company has good prospects. So the idea is not that you abandon your research, is you just inform it based on momentum. So let me give you some examples, and some of these I've talked to you before, and as you can see, my record is not perfect. I did buy LAES, Seals Q, on a day that it had a sputter, and it continued to have more sputters. So I'm down 15%, but you can see that the rigidity and the quantums and the qubits, they are up fantastically on a day like this, where all quantum stocks are down and there is no new news. I would add more to these stocks. And just by doing that, where I see the momentum of a stock that has been going up, take a sputter, just by adding more, when it goes up the next day or 2 days later or 3 days later, you can see how I accumulate huge amounts of gains. That is what I mean by momentum trading. And what you're seeing here is an example of a sputter after a growth streak. Let me show you what a glimmer after a dull streak looks like. Target used to trade at a 52-week low. Moderna used to trade at a 52-week low. Same for CVS. So again, I look for stocks that have a sudden burst from the left-hand side or the 52-week low, and I look for news that justifies it. And in those cases, I go in and buy those. And if you play that for a little bit and you start doing your fundamental research and you start doing your rationalization and you do not abandon your fundamentals, I at least got lucky both on the left side of the momentum and the right side of the momentum. And then you go back to the thesis. The next thing I want to prioritize in momentum, growth, house money, and long term is revenue growth. Run a simple Schwab filter for companies whose revenues are growing, they do not have a lot of debt, and they have a reasonable price to cash flow. And all of these are filters I've explained in value investing before, pardon me. and you come up with these 7 or 8 stocks, and you can again see that all of these are, up and down quite a bit. On a good day, everything goes up. On a bad day, some things go down. And I'm in general up on all of these stocks that satisfy revenue growth. And then I go to the next element of it, which we've talked about before, which is when it appreciates, sell off the basis so you protect your gains. So what does that lead you to, and what did that lead me to? More importantly, I'll explain what my holdings are. Here are my equities, and as you can see, the gains range from 150% to 3%, and there is another half page to come. In this area, every time it crosses the 40-50% mark, because my target is a 20% return, if it crosses the 50% or 40% mark, I take out the basis. When I take out the basis, I just trade on house money, so I really have no risk on where these stocks go from now on. Then I look for the what I call the glimmer after a low. That's the Moderna, CVS, and Target. And lastly, I look for the sputter after the high, which is the Joby Aviation, Nvidia, Baker Hughes. Cal-Maine is my all-time favorite. It's very hard for me to think about selling it. I'm sitting on long-term gains, so at some point I'll offset my long-term losses with it and sell it, but it's done very well for me. The other half of my stock, and as you can see, I do have some blunders here. MCOR and Powell Industries had a blip after their last earnings, and so I bought them, and they are up so far. And quantum computing is an area that I'm fascinated by. I'm educating myself, and so I went and bought a bunch of quantum computing stock companies in that industry. Last but not the least are the 4 dark horses. Let me explain what I mean. Each one of these has an event, kind of a twilight zone, if you will. Let me give you the first one, Tenet Healthcare. They have done amazingly well every single quarter in the last 6 or 7 quarters, and their earnings are coming up. So I'm buying Tenet just for the earnings, and I'm hoping they can deliver on their promise. United Therapeutics has a litigation. If they prevail in that litigation and the result is supposed to come out, it will add $1 billion to their sales. It's insane what is going on with that company. Read their quarterly report if you're interested. Natera is another dark horse. Their technology is a game changer. They can detect disease in a man and a woman before they have a child. And that's just one example. They can detect cancers before they manifest themselves. It sounds a little too voodoo, and they are actually starting trials in Europe now. I have high hopes for it, and I'm going to sit on it and see where it goes. The last but not the least, ironically, is Meta. And here is why I'm excited about Meta. On January 10th, the Supreme Court, the United States Supreme Court, will hear a case on TikTok. If there is a dark horse event where TikTok is banned, whether it's permanently, temporarily, the new administration removes the ban, who knows, there will be a huge influx of ad dollars into Instagram, which is owned by Meta, and that is my play. Having said all of that, my equity allocation still shows an extraordinarily high allocation to consumer staples. Thank you, Cal-Maine Foods. But I am plugging the hole with information technology with some of my new quantum buys and Meta and so on. Industrials is another area where I'm heavy. Where am I not? I don't do consumer discretionary. I haven't seen anything exciting. I don't do real estate or utilities, and I have nothing in financials. So I'm not as they call a diversified investor. I have my thesis. I invest based on my thesis. It's very important for you to have your own thesis and do your own research. I still have a substantial amount, 78% in short-term treasuries, and I probably am not going to change that too much. Having said all of that, I will be watching for the next 90 days to make my moves, and I hope you are too. Thank you for listening to Yield Nerd, and happy 2025.